In the 1980s, the financial industry was rising, and people on Wall Street were getting rich. They invested in many sectors, one of which was real estate. Back then, if you wanted to buy a house, your money went to a local lender, and since mortgages took decades to repay, lenders were careful. But people wanted to invest in real estate and change this old system. In 2001, the U.S. financial sector dominated. This new system connected trillions of dollars in mortgages and other loans with investors all over the world. 5 investment banks, 2 financial conglomerates, 3 securities insurance companies, and 3 rating agencies made up the securitization food chain. In the new system, if you wanted to borrow money from a bank in order to buy a house, the bank will agree. But if you can't pay them back, they will take your property. That's where the investment banks come in. If the company wants to take a loan, they will call an investment bank and they will connect them with someone willing to lend them money. They will act as the advisor and be part of the process. Let's say we have thousands of homeowners and they all take out loans from the bank. The banks combined thousands of mortgages and loans, including student loans, car loans, and credit card debt, into collateralized debt obligations, or CDOs. Then they would put a price on these CDOs and sell them to other buyers or investors. Now, when homeowners paid their mortgages, the money went to investors all over the world. So many people invested in real estate. And for investors who owned CDOs, AIG, the world's largest insurance company, started to do insurance a little differently. Unlike the regular insurance, where you can only insure your own house once, AIG was letting anybody insure that house. So if the house burns down, the number of losses becomes larger. One of the banks that was heavily invested and involved in real estate was Lehman Brothers. The 4th largest investment bank in the United States, and the largest at that time, their total assets were valued at $691 billion. In February 2007, the stock price was at an all-time high of $86. After the Wall Street crash in 1929, the United States federal government created the Securities and Exchange Commission, or SEC. The primary purpose of the SEC was, and still is, to enforce the law against market manipulation. In 2004, Henry Paulson, the CEO of Goldman Sachs, helped lobby the SEC to relax limits on allowing the banks to increase their borrowing. The SEC somehow agreed, so the investment banks were borrowing heavily to buy more loans and create more CDOs. Eventually, the banks had more borrowed money than their own money. They didn't care whether a borrower could repay. The more CDOs they sold, the higher their profits. As a result, anyone could get a mortgage, and housing prices skyrocketed. From 1996 to 2006, home prices effectively increased by 194%. When the securitization chain imploded, lenders could no longer sell their loans to the investment banks. As the loans went bad, dozens of lenders failed. The market for CDOs collapsed, leaving investment banks holding hundreds of billions of dollars in loans. Banks all over the place were harmed, but Lehman Brothers lost the most. Because they were heavily involved in real estate, they tried to sell everything they owned to pay off their debts. But they couldn't sell everything because so much of it was tied to all these investments that no one wanted to touch. They had $691 billion in assets, and only $7 billion of it was available in cash. On September 12, 2008, they had run out of cash, and the entire investment banking industry was sinking fast. 3 days later, they filed for bankruptcy. This is a graph that shows the top 10 largest bankruptcies of all time. Not one of them can compare to that of Lehman Brothers, who became the most significant bankruptcy in U.S. history. On October 4, 2008, President Bush signed a $700 billion bailout bill. But world stock markets continued to fall. 2008 was known as a financial crisis, which was also called the subprime mortgage crisis. The bankruptcy of the U.S. investment banks and the collapse of the world's largest insurance company, AIG, triggered a global crisis, threatening to destroy the international financial system. The result was a global recession, which cost the world tens of trillions of dollars, rendered 30 million people unemployed, and doubled the national debt of the United States. Unemployment in the United States and Europe rose to 10%. The CEOs who plunged the world into crisis walked away from the wreckage with their fortunes intact. The top 5 executives at Lehman Brothers made over $1 billion between 2000 and 2007. At the end of the day, the poorest paid the most, as they always do.